Hello and welcome to the Mutual Fund Show. My name is Niraj Shah. Now, this is, at least for us, the third show in a series of four shows that we are doing. Show number one, where we spoke about the basics of investing in mutual funds, what percentage in equity, risk profile, etc., that is to be considered, eventual goals, etc. Show two, which was last week, we spoke about the metrics for choosing a fund manager experience, fund house, any ratios like Sharp ratio, etc., that should be considered. So we discussed that. Today's show is about how to monitor the performance. Once you invested in the fund, how to monitor the performance of the fund. Is it as simple as just look at the NAV and how is it going up, or is there more to it? And how to decide when is the good time to exit a fund, because a lot of you will probably buy into a fund. And the belief would be that investing in a mutual fund should be for the long term, but you might be in it for 5 years, 6 years, 7 years. And maybe due to certain factors, it might be a good time to exit the fund, but you don't do it because you don't monitor the performance. So, or you don't take into account the factors that should be considered. So I think that's what we are trying to do today. How to monitor the performance of the fund and when to decide when to exit the fund. And there could be some qualitative and quantitative factors for that. So again, welcoming back Amit Bivalkar and Tarun Birani to speak about these two topics. Gentlemen, both of you, thanks so much for joining in. Tarun, just in a nutshell though, and then we'll get into the details, but in a nutshell, how do you monitor the performance of a fund that you are invested in?
Yes. So, Niraj, while getting into the performance side, it is the most important part which we have to look into is the actual performance versus the relative performance. Most of the times, let's say I invested 3 years back 1 lakh rupees, and my 1 lakh rupees value is, let's say, 1,10,000 only. So 3 year my annualized returns is, let's say, just 3% on an annual basis. This is something which this is my actual performance, but let's get into the second part, the relative performance. Relative performance will tell you, compared to the benchmark, how did I perform. That is one way to look at it, and that gives you a picture of the sector where the category where you have invested. So that is the way I look at investment returns, that the benchmark where you have invested, that is very critical. I look at another parameter which is called rolling return. So again gives you a long-term picture of that fund, that how it is performing with a 1 year, 3 year, 5 year basis. So and calendar year return again is very critical. So it is very important, and that is one of the very big actual performance versus the relative. Most of the investor looks at only actual performance, but we need to get into relative performance. That's what I look at.
Okay. A slight audio issue there, but I think what Tarun was trying to say was that looks at the relative performance versus not just the absolute performance, but the relative performance as well, and various ways, rolling returns, trading returns, etc. So that's the brief, and then a couple of other points. But Amit, same question to you in a nutshell, and then we'll dwell in detail. What are the factors that you take into account when you're monitoring the performance of the investment that you've done?
So you need to look at quartile performance based on how the fund has delivered over the index, as well as in its broad peer category. We have observed, Neeraj, is that if you are a consistent quartile 2 performer, then actually you end up becoming quartile 1 on a long-term basis. So whether you are investing through advisor or you are investing direct, what you need to understand is look at consistency rather than topping the charts for the fund performance. Look at relative to the benchmark as well as look at relative to the peer. It may so happen that we might end up comparing a dividend yield fund with a value fund or a growth fund. So have the categorization in mind, look at the relative performance and the performance of the fund vis-a-vis the benchmark of the scheme. I think we'll look at that and consistency in a quartile 2 scenario.
Okay, so I would presume that largely the conversation is similar. There are maybe a couple of other nuances that each advisor would probably add. So let's try and develop on those. Now, Tarun, let's start off with what you said. Rolling returns, trailing returns, something that you monitor. And a lot of actually, we've done a show sometime back on the concept of rolling returns as well. So I hope people can actually log back and try and see it in detail as to what it meant. But Tarun, just briefly, how do you monitor these via the parameters that you chose, which is the rolling returns, trailing returns? And then we'll get onto the other factors too.
Right. So let me give a very small example of rolling return, and I shared that chart with the team. That almost let's take example of multi-cap funds, and we have four multi-cap funds. And while we look at rolling returns, let's say from a three-year basis, from last 10 years. Mind you, from last 10 years, the 3-year rolling return study will give you a picture of the consistency of this fund, that what is the minimum return which this fund is generating compared to the category where we have invested. And it is very critical that you compare it with the category. So once you get there, you know what is the minimum this fund is getting you compared to the category. Then you get into the maximum, median, then you get into the average part, as well as then you start seeing that this fund, how many in the rolling return data, how many times it has given 10%, 15%, 20% return. That again talks a lot about the consistency, whether it's a high risk fund, low risk fund, or a medium risk fund. So this rolling return study is according to me is one of the best study whenever you are comparing funds. Looking at only the trailing return is not a great idea to look at performance. Again,
No,
yes.
Tarun, sorry, just a quick follow-up. Is it possible for an average investor to calculate rolling returns? Or does it come in the fact sheet? How does a person get rolling returns?
So actually, this data is available with many sites. If you search on Google, you will find on any scheme you are asking for, you will get a rolling return. But yes, it is not available on the fact sheet. One need to really deep dive into it to get this data. Yes.
Okay. Yeah, please carry on. Sorry, you were finishing your point.
Yeah, the second important is the calendar year return, and Niraj, I can tell you this calendar return again can save a lot of misery for investor. So let's say I look at last 3-year performance. Let's look at last 3-year performance of various benchmark. Like Nifty has given 7% return in last 3 years. Mid cap index has given 1% return. Banking index has given -2% return. So while it's very easy to generalize that, okay, the mid cap funds have not delivered more than 1% average return. But when you start getting into calendar year return, then you start observing much more deeply, because this, let's say a mid cap as a category from 2018 to 19, we had all these SEBI issues with the mid cap category. So due to that, these 2 years were like complete washout for the mid cap category. But starting 2020, if you start looking at mid cap funds, you will start realizing there is a stark change which is coming in the performance. So my suggestion would be looking at returns more from a calendar year return, and this calendar information is available very easily. Every year calendar return of any fund you ask for, that is available very easily.
What difference would it make, Tarun, if I look at calendar year returns versus maybe a financial year return? I mean, the event that we are talking about could have happened in between calendars or in between financial years as well, right? So why this calendar year choosing?
So calendar year return will give you, so like this is like checking your performance on every year basis. So let's say if I look at any X fund, and if I look at the calendar year return of that fund, I know year 1, year 2, year 3, year 4, year 5. So whether in these 5 years, whether I am a quartile 1, quartile 2, quartile 3 performer. Because when you look at point to point return, let's say if I look at last 5-year return, just last 6 months I may be a great performer because maybe a very speculative stock like DLF is part of my portfolio. Due to that, I got the performance. But when I talk about consistency, I want my fund in last 5 years, whether at least a quartile 2, quartile 1 kind of performance is there or not. That calendar return only will give you that picture.
Okay. So it's essentially any form of annual return. So it could be 2019, 2020, it could well be FY19, FY20, whatever, but periodically, annually.
Correct. That's very critical.
Okay, great. Thanks for that, Tarun. Amit, can I ask you to come in on one of the points? And of course, because you also mentioned the importance of checking what quartile the fund performance is, etc. Can you elaborate a bit there?
So I think three important ratios what Niraj one needs to consider when he looks at performance. One is your alpha. Alpha is nothing but excess return delivered over benchmark. That is your alpha. Then you have got something called beta, and I'll explain beta in a minute. Suppose the fund is what you can say a beta of 1.2. It means that if the index delivers 10%, this fund is going to deliver 12, either on the upside or on the downside. So the volatility of the fund is measured by beta, wherein if the beta of the fund is higher, it means that the fund is going to be more volatile on the upside as well as on the downside. So first one was alpha, where you have excess returns over the benchmark. The second is your beta, which tells you how much volatile this fund will be. And the third is standard deviation. Standard deviation will tell you that from the median, how much does this fund fluctuate. So if you take a combination of all these three, and mind you, people have this things in mind that this fund has performed well, therefore I should move out, or this fund has not performed well, so I should not put my money. So it's a very tricky situation, Neeraj. You should look at alpha, you should look at beta, and then you should look at standard deviation, and then arrive as to which fund you should actually invest into.
Okay, can you give a small example, Amit, just so that people can understand what kind of importance would you give to what ratio, if at all, and how would it work?
So alpha is the excess return. Most of the times we try to give too much importance on alpha, and because of that we end up trying to buy winners of yesterday. So if a fund has delivered great returns over the benchmark in the last year, we try and find out that whether I should put in my more money. A simple example I'll try to give you. Small caps over the last 1 year, Neeraj, have delivered stupendous performance. Now, if you want to look at that and say that I want to put my money into small caps today, probably then we are not doing justice to your risk profile. So then it comes a measure of standard deviation, wherein how much has the fund moved from the average or from the median over long periods of time. So as Tarun said, over 1 year calendar returns or 3 year rolling returns, try to find out the standard deviation of the fund. And the third one is the beta, wherein what we try to say is that how much volatile can this fund be and can you stomach that volatility. So if the benchmark gave a return of 1 and if the fund is having a beta of 1.2, that means the fund is going to be outperforming by zero point 0.2 or underperforming by zero point 0.2 to the benchmark. And these ratios are available. These are printed in fact sheets. So one needs to go through those ratios before actually coming to choice of a fund.
Okay, so viewers, Tarun recommends periodic checking annually, whether it's calendar or financial year. You can take a call there and look at rolling returns instead of just pure trading returns. Amit Bilukar suggests look at the alpha, the beta as well as the standard deviations of these funds. One final question on the fund performance before we get to, or how to monitor the performance before we get to when to choose to exit the fund as well. And same question to both of you. Tarun, I'll come to you first. Do you look at nowadays I've seen funds send me the monthly portfolios of what they've bought into or sold into select funds at least. Yeah, what is the portfolio looking like? How much of an importance do you give to this monthly monitoring as to what kind of stocks are they buying into? Are they buying some risky names, etc.? Should people get in that kind of minutiae?
Yeah. So Niraj, very good question, and I see one need not get into this process because otherwise you should get into stock picking yourself. If you have given your money to someone as senior as a fund manager, I think the monthly monitoring and all this getting into that process, I don't think that is a great idea because then you may get biased and you may start taking some decisions which are not correct. I think this is very critical from a setting up investment objective point of view because most of the people don't set up investment objective very clearly, don't get into suitability exercise clearly, and that's where they get into this monthly monitoring. They start getting into too much of what is happening every month, this stock is moving or not, which is the highest portfolio holding. I don't think that is required anyhow. What is most important part is whether there is a serious issue in terms of management of that fund, whether there is a fund manager change and all that. All those things are critical, which are very fundamental to the fund. So those factors need to be understood much more in detail. And there are basically 4 P's on which we look at performance. One is the parent, which parent that fund house belong to. the people, what fund managers are there, part of that, what is the performance, and then the process. If these four parts on a overall basis is good, I don't think one need to get into all these monthly things regularly.
Okay, Amit, what about you? I mean, aside of the observations that you made, I mean, do you look at these monthly things and anything else that you look at too from a fund monitoring perspective?
So more importantly, if the objective of the fund is defined and the fund manager is buying according to the objective, I think you don't need to look at what is buying and what is selling on a monthly basis, because Neeraj, over analysis actually leads to paralysis. We only get data end of month. Yes, you can look at the turnover ratio of the fund as to how many times is it churning the portfolio in a year. What is more critical is to look at the turnover ratio, because buying and selling in a fund, it can happen mid month and which might not get reported. So this might be something which you don't want to look at into detail. As advisors, we definitely have to look at it, because whether he's adding position in a sector or a stock, that's our job. But for an investor, he needs to look at what is the objective of the fund. Is the fund manager sticking to the objective? And what is the turnover of the fund? Along with that, on the monitoring side, Neeraj, one important thing is also have a look at the expense structure of the fund. I think that is also critical when it comes to monitoring performances.
What are the ideal numbers for both of these, Amit? The expense as well as the turnover. Is there a ideal number?
There is no ideal number, but typically a turnover lies between 40% to 50% of the portfolio. You look at 1.2 to 1.5 as the range when it comes to turnover. And when it comes to expense ratio, I think actively managed funds are anywhere between 1.5% to 2%. And passively managed funds are anywhere between 0.3% to 0.5%.
Okay, viewers, keep in mind, I mean, these are interesting nuggets to follow. The turnover, I would presume, Amit and Tarun, please correct me if I'm wrong, but I would presume that the higher the turnover of the ratio, the more the churn in the kind
That's
of
correct.
assets
Yeah.
that a fund is holding, and therefore
Yes.
it probably shows indecision on the part of the fund manager, or maybe some more risk taking nature of the fund manager in order to try to get that alpha. Anything else, Tarun, that you want to add before we move on?
No, I think this is it. But one more important part, let's say we are talking about small cap funds. So it is very important. So when you spoke about the monthly monitoring part, something like a category like small cap fund, I think this is a part of a very tactical portfolio. And again, timing becomes critical in a category like small cap funds. So let's say if you have started with 100 and your value is already 200. So I would definitely look at a monthly monitoring of a fund like a small cap fund, which is a very tactical fund in my portfolio. That is not my core portfolio. So that there also one can look at monthly monitoring. Yes.
Okay.
Neeraj, I just want to add one thing here, that many times people get confused between absolute return, annualized return, and compounded annualized growth return. So I think investors have to look at CAGR return for 1 year performance, while on to 2, 3, 5, 10 year, you have to look at a XIRR or a IRR kind of return on the funds. And maybe you can do a show, Neeraj, on
what's the
how to.
difference?
So that's what I said. It's a concept which, if you have 15, 20 minutes, it will be well explained with a chart. So the next time, if you want to.
We'll do that as well, Amit. We will do that. But can you do it in 2 minutes right now for the sake of this show?
Yeah, so on the CAGR part, it only tells you like a compound interest, what is my money moving and how is it moving year on year. XIRR actually gives you, if you have redeemed some money within the years of investment, the reinvestment return also gets calculated when you do actually XIRR. So it will be better if we show this on a chart next time, and then we can explain it in a better way. Absolute return is nothing but 100 rupees. If it is 200, then you have got 100% return. If it is on a 5 year period, the CAGR will show you something like 17, and maybe a XIRR will show you like 16.8. So we can display that once we have a chart in front of us, Neeraj.
Sounds good. We'll do that the next time. Okay, let's move on. When to exit a fund, right? Everybody puts in the money. Well, how about telling them when to exit? Amit, let's start off with you this one.
I think exit a fund because you have made your target return is not the right strategy, but whether you have achieved your goal for what you had put your money. Suppose Neeraj wants to buy a BMW in 5 years and he had invested and his corpus is ready in 3 years. And if his corpus is ready in 3 years, although his goal was 5 years hence, I think he should take out the money. So if you are taking out money for spending or consumption, Neeraj, then it's perfectly all right. If you have achieved your goal and you want to redeem money before time, it is perfectly all right. I'll give you a small example on this. Suppose you have invested 20 lakh rupees in a fund, and suppose the fund has delivered 10% and you have got 22 lakhs with you. Most of the times, the mistake what people make is they redeem the 2 lakhs, which is the profit, and they say that I have redeemed my money. Now, just give me a minute to explain this. They redeem those 2 lakhs and probably they go into any other fund or they keep it in the bank. Suppose the market cracks by 10% after they have booked the profits. The 20 lakhs which is remaining in the fund will go down to 18. While if we had kept 22 lakhs as it is in the fund, there will be a difference of only 20,000 rupees had he not booked the profits. Second thing is, if you redeem that 2 lakh rupees, what are you going to do with it? That is also important. Many a times, you see that clients moving from one fund to other equity fund by booking profits in one fund and entering other equity fund because the NAV is less than the fund they are invested in. I think these are myths we need to break. So if you want to do any spending, if you want to consume something, if you have achieved your goal well before time, that is the way you should actually book your profits, because after you exit, entry at a lower price, which is the major reason of people, that is not possible at all times.
Okay. So those are qualitative factors, goal-based factors, if indeed this happens. Let's try and take it on the level. Tarun, my question is, let's assume that my goal is not reached, but surely there could be factors which should be taken into account to exit a fund, even if my goal is not reached, right? Because the fund maybe, or the theme or the story may have changed or something. So are there things that one should safeguard against or keep in mind?
Sure. So most important factor we mostly look at, apart from reaching the financial goal, is first of all rebalancing factor. So as we have clearly defined, while you are doing a suitability exercise, there is a very clear-cut demarcation on the risk tolerance level. So let's say if we have defined a 50-50 portfolio for a client, and with the rise of the market, this 50 becomes a 60%. In that cases, a 10% rebalancing is something we strongly advocate. Always stay in your means. If your defined risk tolerance is 50-50, please redeem that 10% and get out of that. That is one very strong reason I would recommend to exit a fund. Second important reason would be the change in the investment strategy of the fund. And let me give you some real-time case study, which I have observed in many hybrid funds currently. So let's say last 2 years, I have been observing many hybrid funds have been taking excessive risk in their debt portfolio. And they have been taking a lot of credit calls in the debt portfolio. So trust me, when I have looked at a hybrid fund, my plain vanilla idea to look at hybrid fund was that I want somebody who is actively doing that rebalancing 70-30 of the portfolio. But what I observed that 30-35% of the debt portfolio, the fund manager is taking excessive credit risk, and that is something was not my investment objective, because I wanted to safeguard my 30-35%. So in that way, what I would look at is put that 35 rupees in a pure debt category and 70 rupees into a pure equity category. So that is one very big learning which I had over a period of time, that investment strategy change whenever you see. And like recently we have a multi-cap fund. I think last week we have observed that SEBI has given a diktat that they will change the structure of that mid cap, small cap, large cap. I think one need to get very serious about it, because the mid cap and the small cap proportion of the portfolio will dramatically change with this change in the multi cap category. So if that something like that happens, we need to really look at the overall risk profile, and there also the change need to look at. Yeah.
Neeraj, I have a different view on this.
Yeah.
I think SEBI will not allow operators to front run the mutual fund. and therefore it will not happen that you will actually go and end up buying small cap. Why you have not bought small cap in a multi-cap fund? Because the fund managers don't want to buy small cap there. I think you will soon get maybe a fresh leaf live from SEBI, wherein you can either merge this fund with your large or mid cap, or whether you can have a flexi cap as a category, which will open up. That was point number one. Point number two, when you're doing a rebalancing or a asset allocation, mind you, it is very difficult for a retail investor to do this rebalancing. If you have a large portfolio, Neeraj, it actually makes sense to do this rebalancing, because if you have a 5 lakh rupee portfolio invested 50-50 into equity and debt, suppose that 2.5 lakh rupees have gone to 275, and that tilts your asset allocation. I don't think so. You are going to take the pain of shifting 25,000 rupees from equity to debt. Because if that money is for long term, then I don't think so. You need to do that because you will break the compounding in an equity fund. So if your portfolio is large, then I 100% agree with Tarun that we need to have rebalancing as a strategy. But for retail, put a straight jacketed formula: equity money for 10 years, 15 years, 20 years, debt money as an alternative to fixed deposit, because post tax you will get a better return.
Is the argument though, Amit, about two things? Is the argument about a hybrid fund taking excessively risky credit calls a valid one though, right? Because you don't want that to happen in your hybrid fund. You invest in your hybrid fund for safety on the debt side.
So more importantly, it is what is the fund objective. You
Right.
will be comfortable having a veg pulao, and if you want a veg pulao, you don't want to have chicken along with it. So if you want equity, you go for equity. If you want debt, you go for debt. Have your percentile ready, and just go and sit tight in those funds for a long period.
Hmm. Viewers, just one quick thing. On the multi-cap side, I partly agree both with Tarun and Amit. And the reason why I'm saying this is this, that it could well happen from whatever little SEBI announced the last time. And a lot of queries came about what to do about this. It could well happen that that SEBI may take on board some requests or some recommendations from AMCs about what to do with mutual funds. And what Amit was saying, that some of these might be given a chance to either convert into quote unquote a flexi cap category or merge with the large cap funds, in which case you will be told by the fund house that we are going to take this action. Do you want to redeem your funds or do you want to stay put and get merged in that category? The point is, as Sunil Subramaniam of Sundaram Mutual was saying, that some of the fund houses are actually happy with the multi-cap category and they do not want to shift. And therefore, if indeed your fund house doesn't have the adequate 25% allocation to mid caps and small caps, then that allocation might go up or go down. For example, Quant Multicap is a very small fund, but it had 40% allocation to small caps. So I think they will have to cut down their allocation as well. So those changes would happen. So keep in mind that what Tarun also said was in a way right, that some of the allocations might change because the fund house may want to continue having a multi-cap fund and your fund might be in that fund house. So you have to monitor both of these parts very, very carefully. In a lot of cases, the fund house itself might get a chance from SEBI to merge it with some other category or otherwise. So keep that at the back of your mind. Just one last question, Tarun. The first plate that you gave out in your answer, in the first answer, you mentioned about how you would also look at a fund manager exit as a sign of whether or not to stay in a fund or get out. Did I get you correct? And why would you do that?
Yeah. So a leader of an organization is always a very critical factor while getting into anything you start with. So similarly for a scheme, any fund manager who is driving that fund is very important, because let's say, and this is very critical for a category. Let's say if I talk about a small and a mid cap category, because the investment style of the fund manager is something which helps you generate that extra alpha. And when you see the exit of that fund manager happening, I think this is a very serious issue, because you need to be careful that the kind of alpha with which expectation you are coming in, that might not hold true. Another guy coming in, that may completely change for you. So that is where you need to be very careful about it.
Okay. Viewers, this has happened in the past. I think IDFC went through this, I think, when Kenneth Andrade moved over to start his own one. So that's the most important, recent example that I can think of. Maybe there are others, but just bringing it out. Amit, one last question to you. Anything else aside of the financial goal reaching part that you would be taking into consideration in a meaningful way in order to decide when to exit the fund?
For me, more importantly, Neeraj, is that whether the fund objective is continuous along with the SID and SI. If I am comfortable with the fund objective and I am going to stay put in the fund, I even don't follow fund manager exits. Why? I will tell you. Because if there is a process, if there is a framework as to how the fund has to be managed, I think there are 7 billion people and nobody is indispensable here. Why does a Starbucks coffee taste the same across outlets? Why does a McDonald's burger taste same across outlets? It's because there is a process and there is a framework. People might laugh at this, that how can this be applied to investments? I think if you have the filter, the screener very much cut out, if you have the framework as to what stocks you can buy, it's just that the fund managers wait on which stock to buy how much. I think that is more critical. So just trust on the framework and policies and the processes which a fund manager sets out. If you agree with that, I will probably not have to exit even if the fund manager has actually quit.
So, well, it's very interesting that both our advisors have slightly different views on a couple of very important things. Viewers, what I'll tell you is that if you ever encounter any such situation wherein if there's a fund manager exiting, for example, and if you're confused, well, do send in a question to us and we'll try and get that answered, or ask your advisor or what to do in a scenario like this. Is it worth getting out of the fund or is it important to stay in the fund? But we are out of time completely on this show today. We actually exceeded the time. But Tarun, Amit, thank you so much, gentlemen, for joining today and giving us your perspective.
Thank you, Niraj. Thank you.
Thank you, guys. Thank you, Amit.
Thanks.
And viewers, thanks for tuning into this leg of the Mutual Fund Show.